how does a company that builds top secret deep sea nuclear submarines also justify building private luxury corporate jets for billionaires?
Yeah, it sounds like a contradiction, doesn't it?
It really does. And today, we are answering that exact question by sort of hacking our way through a stack of documents that honestly felt like they were guarded by the Pentagon itself.
Oh, for sure.
Seriously, to even access the sources for today's deep dive, I had to pass a Cloudflare security verification just to prove it wasn't some, malicious bot scraping the data from MarketBeat.
Which is honestly a very fitting hurdle, especially when you consider the sheer scale and the sensitivity of the information we are looking at.
Right. It really sets the mood perfectly. Because today, your mission and ours is to decode the health, the trajectory, and just the massive operational footprint of a global aerospace and defense titan.
Exactly.
We are diving into the Q1 2026 earnings report and the accompanying investor presentation from General Dynamics, dated April 29, 2026.
And we are definitely not just going to read numbers off a dry financial spreadsheet. I mean, nobody wants that.
No, definitely not.
The goal here is to connect these abstract billions to the physical reality of what this company is actually manufacturing. We are talking about an enterprise that bends thousands of tons of steel for the U.S. Navy,
Yeah.
while simultaneously stitching custom leather seats for high-altitude aviation.
It's wild. Our mission today is to take these PDFs and translate them into a real-world picture of what General Dynamics is actually building and, what their staggering financial growth tells you about the current state of global demand. Okay, let's unpack this.
Let's start with the sheer velocity of the money moving through this organization, because the top-line numbers for the first quarter of 2026, well, they paint a picture of a company operating at a blistering pace.
They really are something else.
Yeah.
Let's hit the headlines first. So revenue for Q1 hit an incredible $13.48 billion. That is a 10.3% jump from the exact same quarter in 2025. And operating earnings reached $1.42 billion, which is a 12% increase year over year.
Wow.
Yeah. And their diluted earnings per share sits at 4.10. And just for clarity, when we say diluted, we're looking at the most conservative, realistic calculation of their profit per share.
Right. It assumes all potential stock options and convertible bonds have already been cashed in.
Exactly. And every single segment of their business saw growth.
What stands out to me even more than the revenue jump, though, is the commentary from their CEO, Phoebe Novakovic.
Oh, yeah. What did she say?
Well, in the report, she highlighted the company's, quote, strong operating results and excellent cash conversion.
Cash conversion.
Yes, that phrase, cash conversion, is the absolute lifeblood of a sprawling manufacturing empire like this one.
And the report totally backs that up with a wild statistic. It says net cash provided by operating activities was $2.2 billion.
Which is massive.
It is. And then it notes that this cash figure represents 192% of their net earnings. I mean, I look at a number like that and I have to ask, how on earth do you generate nearly twice as much physical cash as your official net earnings?
What's fascinating here is that it reveals the incredible financial leverage built into their contracts. See, net earnings, that's just an accounting metric.
Right.
That number includes massive non-cash expenses, primarily the depreciation of their shipyards, their factories, all their heavy equipment.
Okay.
But cash from operations, that is the actual physical money entering their bank accounts during those 3 months.
Which completely changes how you view their balance sheet. If they are pulling in 192% in cash compared to their earnings, that tells me their customers, which is primarily the government, obviously, they're paying them massive sums of cash up front, or at least hitting major payment milestones much faster than the official accounting revenues are recognized on the books.
That is the exact mechanism at play. It is a signal of bulletproof financial health. They have the cash on hand to fund their own operations without taking on excessive debt.
That makes total sense. And that actually leads me right into another metric from the report that I want to dissect, because this is where my intuition usually starts sounding an alarm.
Oh, which one?
I'm looking at their book-to-bill ratio. The consolidated ratio for the whole company is 2-to-1. And for their defense segment specifically, it's 2.2-to-1.
Ah, yes. A critical metric for any defense contractor. Book-to-bill is simply the ratio of new orders coming in divided by the orders you actually finish and bill for.
Right. But if we think about this in everyday terms, let's say I run a local bakery.
Okay, I like this.
If I take 2 new massive wedding cake orders for every single cake I actually pull out of the oven and deliver,
Yeah.
I have a major bottleneck.
You definitely do.
Eventually, I'm going to have a mob of angry brides in my shop because I literally cannot bake fast enough to meet the demand. So, is a 2-to-1 ratio actually sustainable for General Dynamics, or does it mean they are taking on way more than their factories can actually handle?
I love the bakery analogy, I really do, but we have to completely shift our understanding of scale and time here.
Okay, how so?
In your bakery, a wedding cake takes, what, a day or two? In the defense industry, a nuclear-powered submarine takes years, sometimes a full decade to build from the keel up.
Oh, right. Why?
So a 2-to-1 book-to-bill ratio isn't a sign of them drowning in a backlog they can't manage. It is a massive indicator of long-term security.
Wait, okay, I think I see the flaw in my bakery analogy now.
Yeah.
In my shop, I only get paid when the bride picks up the cake.
Exactly.
If General Dynamics ran that way, they'd go bankrupt buying the thousands of tons of steel for a sub before they ever saw a single dime. The 2-to-1 ratio works because government contracts have milestone progress payments, right?
Yeah, you hit the nail on the head.
They get a massive influx of cash to buy the steel, another payment when they weld the hull, and, I don't know, another when they install the reactor.
That is the crucial difference. They are not waiting for delivery to get paid. They are securing their future revenue pipeline twice as fast as they are currently burning through it.
That's incredible.
And they are getting cash injections along the entire journey. That is precisely why you see their total backlog in this report skyrocketing. It's up nearly 48% year over year to $130.8 billion.
$130 billion. That's a hard number to wrap your head around.
It really is. And they aren't trying to deliver all of those orders tomorrow. They are booking out the industrial capacity of their shipyards and factories for the next 15 to 20 years.
So they basically have this absolute mastery over a decade-long supply chain, and they've effectively guaranteed their paychecks for a generation. But to really understand why that $130.8 billion backlog is so massive, we have to look at the specific hardware they are building to generate these numbers. We need to go below the surface and look at the marine system segment.
Oh, this segment was the absolute powerhouse of the first quarter.
The numbers are staggering. Revenue here grew by an impressive 21%, reaching $4.34 billion.
Huge leap.
Yeah. And the report tells us exactly what is driving this volume. It's the Virginia-class fast attack submarines and the massive Columbia-class ballistic missile submarines.
Both incredible feats of engineering.
And it's not just subs. When you look at the images from their investor presentation, you see these massive gray fleet replenishment ships cutting through the water. These are essentially floating logistics cities that keep the rest of the Navy fueled, rearmed, and supplied while at sea.
It is the absolute pinnacle of heavy manufacturing. And that actually brings us to what might be the most impressive underlying number in the marine systems data.
Oh, what's that?
The profit margins. Their operating margin increased by 30 basis points, bringing it to 7.3%.
Now, a 30 basis point jump, which is just 0.3%, that might not impress a Silicon Valley software developer who is used to massive software margins.
True.
But in the heavy manufacturing world of shipyards, moving the needle by fractions of a percent requires monumental logistical shifts, doesn't it?
It absolutely does. You have to understand the physical reality of how that happens. You can't just push an update or change a line of code to make a shipyard more profitable.
Right, you can't just patch a submarine over Wi-Fi.
Exactly. The report explicitly ties this margin increase to, quote, increased productivity across all our shipyards.
Let's visualize that.
Yeah.
What does a 30 basis point productivity increase actually look like when you are building a nuclear submarine?
Well, in a project of this scale, you cannot simply ask your welders to work faster. Productivity is about revolutionizing the staging and the assembly.
Okay.
Modern submarine construction relies heavily on modular building. Instead of building a steel tube and then trying to cram millions of parts, miles of wiring, and specialized plumbing through a tiny hatch.
Which sounds like a nightmare.
It is. So instead, they build entire sections of the submarine independently. They fully load those massive cylindrical modules with all the internal systems before they are ever welded to the main hull.
Oh, wow. So squeezing out an extra 0.3% in profit means their predictive algorithms for staging parts are getting ruthlessly efficient.
Yes.
It means the specialized steel arrives exactly when the welding teams are ready, completely eliminating downtime.
That's the exact mechanism. They are essentially tuning a massive multi-state industrial engine to run just a little bit hotter and smoother.
That's so cool.
When management can squeeze more operational efficiency out of their most complex, capital-intensive segment, it proves they have absolute command over their supply chain. And at these billion-dollar scales, well, 0.3% translates to millions of dollars falling straight to the bottom line.
That's a really fascinating look at the ocean side of the business.
Yeah.
But when you move from the sea to land combat, the demand shifts dramatically, right? From those long-term, decade-long capital projects to immediate tactical needs.
It's a completely different rhythm.
Let's look at how that changes the math in their combat systems segment.
This segment saw a very solid 5% revenue bump, bringing it to $2.28 billion for the quarter.
And the sources give us some incredibly vivid details on where that money is flowing. We're looking at a $730 million award just for various munitions.
Right.
Unlike a submarine that stays in service for 30 years, munitions are consumables. They are fired, they are gone, and they need to be replaced, which creates a constant recurring revenue cycle.
Exactly.
But what really caught my eye in this segment was a $450 million contract from the U.S. Marine Corps.
Yes. That is for the pre-production development phase of the Advanced Reconnaissance Vehicle, or ARV.
Right, and pre-production is the magic word there. It means this $450 million is just the gateway.
A foot in the door.
Exactly. If they succeed here, they're looking at potentially billions in full-scale manufacturing later. We actually have an image of that ARV from the presentation, and it is a fascinating piece of hardware. It's called the Piranha.
It represents a major shift in ground combat philosophy.
Looking at the slide, it is this sleek, multi-wheeled, heavily armored vehicle. It doesn't look anything like a traditional bulky tank with heavy treads.
No, not at all.
It's angled to deflect blasts, painted in a stark, modern gray. And the back of it features these massive, telescoping sensor masts sticking high up into the air.
Yeah, those masts are key.
It looks less like a brawler and more like a massive armored Wi-Fi router. It's designed to see the entire battlefield, process threats, and share that data before the enemy even knows it's there.
Which perfectly encapsulates the doctrine of modern ground combat, information dominance. Whoever sees the field first wins.
Here's where it gets really interesting, though. We have this gritty, heavily armored, mud and munitions combat system segment. We have the deep-sea nuclear submarines, and right next to them, operating under the exact same corporate umbrella and sharing the same earnings report, is the aerospace segment.
Yep.
And what are they building there? Luxury corporate jets.
The iconic Gulfstream brand.
The aerospace segment brought in almost $3.28 billion, up 8% year over year. They physically delivered 38 aircraft in this quarter alone.
That's a lot of planes.
It is. 7 of those were mid-cabin jets, and 31 were large-cabin aircraft. The presentation actually shows this gorgeous high-resolution image of a Gulfstream G800 soaring over the coastline.
Beautiful plane.
Oh, it's stunning. It's got these sweeping aerodynamic wings, those signature massive oval windows. It is the absolute pinnacle of luxury civilian travel. But looking at this portfolio, why?
It does seem like a jarring contrast, doesn't it?
It really does. If your core competency is building nuclear reactors for submarines and heavily armored reconnaissance vehicles for the Marines, doesn't selling private jets to billionaires and massive corporations feel like a distraction from your military mission?
I get why you'd think that.
Good.
But if we connect this to the bigger picture, it is actually a stroke of financial brilliance. Yeah. It is one of the smartest diversification strategies in the industrial world. To understand why, you have to look past the product and look at the margins. The aerospace segment boasts the highest operating margin of the entire company.
Wait, let me check the tables here. Wow.
That's it.
Yeah, their operating margin for aerospace is 15.0%, and it was actually up 70 basis points this quarter. Compare that to the 7.3% margin on the submarines we were just celebrating.
That is the key. They are making more than twice the profit margin on a private jet as they are on a nuclear sub.
That completely flips the script. The defense contracts the subs, the munitions, the ARVs. Those provide massive, stable, long-term backlogs.
Exactly.
They guarantee that the lights stay on, the factories keep running, and the workforce stays employed for the next 20 years, regardless of economic recessions. They provide the ultimate baseline stability.
But the aerospace segment, that provides high-margin commercial cash flow. It diversifies their revenue away from being 100% reliant on the political whims of the congressional defense budget.
That is so smart.
Right. The submarines are the heavy anchor that keeps the company stable in any storm, and the Gulfstreams are the high-octane cash engine driving immediate profitability.
They balance each other perfectly. But as I was looking through these slides, I realized there's a hidden, invisible thread connecting these two very different worlds.
Oh, the tech.
Yes.
Yes.
Because whether you are a corporate pilot flying that sleek Gulfstream G800 or a Marine driving that Piranha ARV through the dirt, You are interacting with immense, hardened computing power. Which brings us to the fourth pillar of this massive company, the technologies segment.
This division includes General Dynamics Information Technology, widely known as GDIT, alongside their Mission Systems group.
And it is a massive operation in its own right. This segment pulled in almost $3.58 billion in revenue, up 4%.
Solid growth.
You can actually see this tech backbone in the imagery they provided. There's a shot from inside a cockpit. It looks like an advanced aircraft, likely a Gulfstream based on the yokes. And the pilots are just surrounded by multifunction displays.
Right, the glass cockpit.
Exactly. There are no analog dials. It is radar, topographical maps, infrared targeting feeds. It is all glass, sensors, and millions of lines of code.
You cannot operate a modern submarine, a next-generation armored vehicle, or a modern jet without an incredibly sophisticated, secure IT infrastructure. The hardware is basically useless without the software network binding it together.
But there was a surprising detail in the financial tables for this specific segment. Despite the strong revenue growth, and despite a really healthy book-to-bill ratio of 1.3 to 1, the technology segment was the only segment in the entire company to see its margin dip this quarter.
Ah, yes.
It went down 10 basis points, from 9.6% down to 9.5%. I'm looking at this and wondering, is that because onboarding massive new IT contracts requires huge upfront staffing and infrastructure costs before the revenue really scales up?
That's a spot-on read of the defense IT space. The report doesn't spell out the exact cause of the 10 basis point dip, but in this sector, margin compression often happens due to the specific mix of contracts active in a given quarter.
Makes sense.
If they are winning and starting up a lot of new large-scale IT modernization contracts for government agencies, the upfront costs of hiring specialized talent and deploying secure servers can temporarily weigh down margins.
But that book-to-bill ratio of 1.3 tells you they are winning a lot of new business. They are happily trading a tiny fraction of current quarter margin for a massive chunk of secured future revenue.
Exactly, which perfectly sets up the ultimate zoom out of this entire earnings report. Because when you look at the future revenue they have secured across all four of these segments, the numbers stop looking like a traditional corporation and start looking like the GDP of a small country.
You were talking about the total estimated contract value.
I am.
Earlier, we mentioned their funded backlog is $130.8 billion. That is money that is effectively locked in, appropriated, and ready to be worked. But the report details another massive category: unfunded IDIQ contracts and unexercised options, totaling $57.6 billion.
It's just massive.
You combine those two buckets,
Yeah.
and General Dynamics is sitting on a potential future pipeline of $188.4 billion.
It is an astronomical figure that changes how a management team operates.
I need you to explain this IDIQ mechanism, though. IDIQ stands for Indefinite Delivery, Indefinite Quantity. That sounds incredibly vague.
It does.
Why is it considered unfunded, but still treated as a vital part of their future pipeline?
It sounds vague because it is highly flexible by design. The best way to think about an IDIQ contract is like the government setting up a pre-approved menu at a restaurant.
A menu. Okay.
Let's say a defense agency knows it will need a massive amount of IT network services or replacement munitions over the next 10 years, but they don't know exactly when they will need them or exactly how much they will need on any given Tuesday.
Right, because geopolitical needs shift constantly.
Exactly. So instead of going through a grueling, years-long bidding and negotiation process every single time they need a software update or a crate of artillery shells, they negotiate an IDIQ upfront.
Ah, I see.
It pre-approves General Dynamics as the vendor, it sets the pricing matrix, and it establishes a massive ceiling, say $5 billion. That money isn't funded yet because the government hasn't placed the specific order.
But General Dynamics knows they hold the menu.
Yes, they have completely bypassed future competitors. Whenever the government gets hungry, General Dynamics is the only one cooking the meal.
That is a massive bureaucratic advantage.
Yeah.
Having $57.6 billion in that specific bucket means they have already won the right to be the exclusive provider for decades of future government needs.
It's incredible security.
When you look at a company that is holding over $3.5 billion in cash on hand today and is staring down a $188.4 billion potential pipeline, you realize you are looking at a fundamentally different type of business. Managing this company isn't about surviving month to month or worrying if you can make payroll next quarter.
It's about orchestrating a multi-decade industrial strategy. It removes the existential dread that plagues most businesses, allowing them to focus entirely on execution and supply chain logistics.
So what does this all mean? If you are listening to this and you want the main takeaway from decoding this stack of financial reports, it is this. General Dynamics in Q1 of 2026 is a machine operating at maximum efficiency across entirely different domains.
Absolutely.
They're squeezing out extra fractions of profit while building the most complex nuclear submarines on Earth. They are ramping up deliveries of high-margin luxury Gulfstream jets to the private sector. And they are stacking up new defense and tech contracts at literally twice the rate they are fulfilling them.
Which leads to a really profound realization about the nature of the defense and aerospace industry.
Yeah.
This raises an important question for everyone listening. When a company has a guaranteed pipeline of almost $200 billion stretching years, even decades into the future, does that kind of extreme ironclad security breed complacency? Or does it provide the ultimate financial freedom to innovate, to refine their supply chains, and to take massive technological risks that other companies simply couldn't afford?
That's a great question.
Next time you see a commercial jet soaring overhead or read a headline about global defense logistics, ask yourself how much of the future has already been paid for today.
That is a fascinating thought to leave on. Just like that Cloudflare security check we had to pass to get into this data, General Dynamics has built an absolute impenetrable fortress around its own future. Thank you for joining us on this deep dive. Keep questioning the numbers behind the news, and we'll catch you next time.